Every single day, forces you've never heard of are moving your money. The Fed, AI, geopolitics, currency wars. Most people only see the headlines, but they never understand the signal beneath the noise. That's what MacroSignal is for. Today, we're asking the multi-trillion-dollar question. Are we currently living inside an AI bubble that's just waiting to burst? Or is this actually the foundation of a totally new economic era? On June 5th, 2026, the Nasdaq had its worst single session since October. We literally saw AI-linked megacap stocks shed hundreds of billions in value in just one day. The trigger? A stronger-than-expected jobs report that rekindled fears of more Fed rate hikes. But underneath that one bad day is a question top analysts are now asking openly. You see, expected long-term S&P 500 earnings growth has hit 20.2%. Now, to put that into perspective, that is actually higher than the dot-com peak of 18.6% back in 2000. So is 2026 starting to look exactly like 1999? I'm going to walk you through the actual data, not the headlines, so you can judge for yourself.
To really understand the scale of what we're dealing with, we need to look at this number, $1.4 trillion. According to tech activist and author Cory Doctorow, that is the staggering valuation of our current AI bubble. And here is the absolute kicker. It has doubled in size in just one single year. I mean, the spending is skyrocketing, the adoption rate is increasing, and the stakes, they're absolutely massive. Because the only thing worse than a $1.4 trillion bubble popping is a $2.8 trillion bubble popping.
But the fundamental why behind this bubble is what's truly fascinating. Doctorow argues that this isn't just your standard run-of-the-mill tech hype cycle. No, he says the AI bubble is the biggest we've ever had because its very foundation is built on the promise of replacing human labor. It's an incredibly intoxicating pitch to executives and capital allocators. But you've got to ask yourself, why are they so desperate to buy into this specific narrative right now?
Well, it really comes down to what Doctorow calls the material basis for the bubble. Let's break this down. When massive tech firms saturate their markets, their growth naturally stalls out. But executives need eternal growth, right? Because a share is basically just a claim on a company's future earnings. If you stop growing, investors revalue your shares at a tiny fraction of their current worth. And if your stock plummets, your personal net worth collapses, and you completely lose the ability to acquire other companies using your shares. So what's your solution? You pivot. You pivot hard to a narrative of limitless margin expansion. You sell the dream of a workplace without workers. When you look at it that way, it's an incredibly rational, financially motivated survival mechanism for the C-suite. Okay, so that brings us to part one. The first cracks appear, looking at historic market dispersion. Let's step away from the macro hype for a second and look at the micro reality. For the last decade, software, semiconductors, and the Nasdaq were essentially one unified trade. If you bought tech, you won. Well, not anymore. In the first few months of 2026, software equities plummeted 30%, literally wiping out years of gains and falling all the way back to 2021 levels. Meanwhile, semiconductors rose 30% to fresh highs. That is a massive 60 percentage point divergence. The broader market isn't just simply going up or down anymore. It is violently picking winners and losers based on who is actually benefiting from AI right now. And BlackRock data really hammers this home. They found that 74% of S&P 500 constituents have moved 5% or more in either direction this year alone. Dispersion across the index has hit the 98th percentile. We literally haven't seen the market rapidly reshuffle winners and losers like this since the global financial crisis. So the absolute crucial takeaway here is that the old rules of tech correlation, they're completely broken. But where is all this money actually flowing on the operations side? Check this out, $47 billion. By early June 2026, Anthropic's annual recurring revenue exploded to that number, up from just $14 billion the year prior. Now on the surface, that looks like an incredible story of fundamental growth, doesn't it? But when we peel back the layers, it's actually a glaring symptom of out-of-control corporate spending. Let's trace how this token budget crisis actually played out. Back in 2025, tech giants were terrified of falling behind, right? So they issued mandates to their engineering teams to basically use the most advanced models regardless of cost. It was a total land grab. But by early 2026, reality finally set in. Teams were exhausting their entire annual AI budgets in a matter of months. Honestly, it mirrors the early days of cloud computing, where developers spun up test servers, completely forgot about them, and created these massively expensive zombie assets. Now, in mid-2026, the mandate has forcefully shifted. We've gone from blindly pursuing capability to strict cost auditing and setting hard financial red lines. That initial wild spending spree, it's over. Right, moving on to part 2, the underlying signal. We're talking about code as an intermediate language. Beneath all this crazy financial turbulence, there is a genuine structural economic revolution happening. The very nature of software is changing. Think about traditional software. It completely relied on massive economies of scale. You had to build a product for millions of users just to justify the sky-high cost of your developers. But AI agents, they flip that entirely. Code is no longer this final packaged product you buy off a shelf. Instead, code has become an intermediate language. You just tell an AI agent what you want in plain conversational English, and it writes the code in the background on the fly to execute your highly personal task. This brings us to what analysts are calling the long-tail revolution, and it's a real game changer. Because generative AI can automatically process unstructured human language into functioning code, the cost of development is basically fallen off a cliff. This means 99% of highly personalized, super niche software demands, things that were way too expensive to ever build in the past, are now totally economically feasible. We're moving away from software that charges per user for a bloated bundle of features you'll never use to a streamlined economy that charges per personalized task. And the adoption is blazing fast. Over 85% of professional developers are already frequently using these AI tools in their daily workflow. However, there is a catch. While personalized, task-based agents for everyday people are absolutely the future, the reality of current token consumption paints a slightly different picture right now. Roughly 65% of the usage is still being burned by professional developers who are generating heavy, complex code. The everyday users, the ones just trying to summarize invoices or sort their emails, are still mostly occasional users. And this creates a pretty big vulnerability. The bubble is currently being propped up by high-intensity professional use, not yet by the massive, widespread consumer adoption we'd actually need to sustain these trillion-dollar valuations over the long haul.
So let's get into part 3, finding the market signal and how we actually navigate this wild 2026 dispersion.
So how do we make sense of all this? We've got massive hype, executive self-preservation, real operational budget crises, but also this undeniable structural shift in how software works. Well, BlackRock points out something absolutely vital. AI is uniquely targeting cognitive labor. This isn't like the past technological revolutions that just automated physical, manual tasks. When a company like Travelers Insurance can use AI to consolidate 4 entire call centers down to just 2 while actually doubling their net income, the implications of that are profound. This drastically lowers labor costs per unit of output. It expands profit margins without companies having to raise a single price for consumers. Structurally, this kind of productivity revolution is deeply disinflationary over the long term. Okay, so what is the actual concrete strategy for this highly fragmented, totally dispersive market? First, you anchor in diversified income. Earning 6 to 7% yields in high-quality fixed income creates a massive margin of safety against all this geopolitical volatility. Second, own compound cash flow equity. You can't just blind buy a broad tech ETF anymore. You have to underwrite companies with durable, free cash flow growth. And third, treat AI as the defining variable. You need to separate the companies that are just buying tokens for the hype from the companies that are successfully translating AI into real, tangible, and durable cost advantages. So we return to our core question. We are witnessing incredible underlying structural shifts in software and productivity, yes, but they're wrapped inside unprecedented trillion-dollar valuations and widespread budget exhaustion. Are we looking at a 1999-style dot-com bubble just waiting to pop? Or is the market simply violently adjusting to the new reality of AI-driven capital? Do you think it's a bubble or no bubble? Leave your argument in the comments below. And be sure to subscribe for more Signal Beneath the Noise. I'll catch you in the next explainer.